Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management. And we're back in studio on a Monday. Ezra, how was your weekend, my friend?
It was wonderful. Lots of family time. Got some relaxing. Got a couple tiki drinks in on Sunday. How about you?
A little bit of the same. Rainy on Saturday, so didn't do a whole lot. And Sunday, spent a little time at the pool after doing a little bit of work on Sunday morning. So it's a good weekend. Good to be back in the studio.
Yeah.
Last couple of shows, we've been out and about, walking around downtown Cincinnati and doing things a little differently here. So
yeah,
it's nice to be back inside with some AC.
Love it, man. You know, and certainly we were talking about the quality of the audio we get in the studio.
No doubt.
It's
and
nice to have the headphones on, and you know.
Yeah, we changed a little bit of the set today. We got some extra lighting going on here, so feeling very important, I guess, is the best way to say it.
You're in a command chair now.
Yeah, for a very interesting week ahead of us here from a market perspective. So This week, actually today on a Monday, things are down across all the major indices after coming off a pretty strong week for most of the major averages, with the exception of energy having an off week, really being the only sector that's positive so far this year in 2022. Energy was down, but the overall other broad indices were up last week, and today is kind of the opposite of that to some degree. But really all this week's about nothing crazy exciting going on. We're going to get some inflation data. That's probably going to be the most important thing people are going to focus on, getting some CPI information out on Wednesday. Economists are expecting a reading above 8% yet again. When we ever see that number come below 8%, I think that's where you're going to start to see a pretty big, significant rally in the stock market, by the way. We'll get some jobless claims information on Thursday. We'll get some retail sales data coming up. And then we're kicking off really earnings season. So corporate profits for Q2 are going to be announced starting this week, most of which are going to be major banks. So JP Morgan, Wells Fargo, we got BlackRock, United Health is also going to be announcing this week, Pepsi and some others. So not a dramatic week for earnings announcements. We're going to have, Apple's and the Microsoft and those guys coming up here in the next couple of weeks in July. And this is really just kicking off earnings season. So, we've been doing these podcasts all year long, going back to when we started, Shepherd Wealth Management in June of 2021. And I always love doing these things, but I got to be honest with you, it's been 6 months of me sitting here talking about, what investors can do or how to handle their temperament and their asset allocation in a bear market. All those things are important. I think we've gotten a lot of good feedback from clients about the podcast shows that we've done. A lot of people that just like the show in general have got a lot of good things out of it. But after 6 months of just seeing a whole bunch of red across pretty much every sector and then in every position for portfolios, it's just getting a little stale. You know what I mean?
Yeah, I agree. It's kind of like low tide on the Gulf of Mexico. It's nice to wait out there, but you can't really surf or do anything,
That's exactly right. And, I'm excited to answer some questions. I know that we got some viewer questions today that relates to some of the topics that are coming down the pike, as well as some news that came out over the weekend and late Friday. So I'm happy to tackle those probably to get us started here. But this is just going to be, a pretty low-key week from a data standpoint, but it also an important week because this is exactly the type of thing that the Federal Reserve is going to be paying a lot of attention to as they're coming out with their meeting at the end of July, 26, 27. So we should see them increasing rates, and they're going to use the data that we're going to see here in this week from CPI as well as jobs or continuing jobless claims. Last week we got the jobs report number, which came in very, very strong.
Yeah.
So to me, this is just going to be a key week for the Fed to say, okay, jobs are strong, inflation's still hot, therefore we still have some wiggle room here from an interest rate hike standpoint, so they're probably going to stick with their 75 basis point increase unless the whole world gets shocked and we get an inflation data that comes in way cooler than what economists had expected. And I think that's what the hope is for the folks investing in the market, for Wall Street in general, is if we can get inflation any way, shape, or form under control, then the hope is, the outlook would probably be, okay, maybe the Fed doesn't have to do 75 basis points. Maybe they can just do 25 basis points, right? Which is kind of what we thought that they were going to do, is a whole bunch of small interest rate hikes coming into this year. But inflation got so out of control due to the war that's going on in Ukraine, they went from, okay, we're going to do 25 to 75 basis points. So if the market expects the Fed to not push the break too fast, too hard.
Yeah.
If they can actually do something less than 75 basis points after the July announcement, then I think that's where we start to see some bottoming in the markets and a pretty significant and violent recovery to the upside. So that's what we get to look forward to.
Yeah.
But I got to be honest, man, 6 straight months of me just talking about a bunch of negative stuff and trying to help people understand perspective-wise that this isn't all that different than a lot of other things that have happened in the past. And I love doing that because Warren Buffett said it best. The one thing that we learned from human history is that humans don't learn from history.
Yeah.
Right? Very, very true. Which is why, I have to tell you, I put this in my most recent newsletter to clients. I have to say the words, past performance does not guarantee future results. Like that is what I'm required to say as a fiduciary. I don't think that that's, anything that gets anybody all excited when they hear those phrases. But really why I say it is because I have to. But the reality is the market is made up of a bunch of human beings.
Right.
Human beings' behavior is pretty darn predictable. We've got a pretty good sample size, right, of what human behavior looks like specifically related to things like investing in the stock market. And we can take some pages from history. And you can't say, hey, this is what's going to happen exactly on this specific date and this specific time. But you can give yourself a high degree of confidence that something similar is likely going to come down the line based on what has happened in the past.
Well, sure, but you can't look into the future and say, oh, in 10 years there's going to be another conflict in Europe or we're going to have another pandemic. I mean, I wish it weren't reality. We'll probably see that again at some point, but that's why, those external factors that highly mitigate the market, you cannot actually predict when they're going to occur. So, I mean, somebody told me a long time ago, never invest into the market, anything you don't feel comfortable losing.
Yeah, that's exactly what Buffett said. He's like, hey, don't invest in something that you don't understand.
Right. So it's like when I go to put some money into the market, move it out of my, liquidity and into stocks or, whatever I'm going to purchase, I just assume that money's gone and I don't invest it if I can't afford to lose it. Because while I do everything I can to inform myself and make the best decision, I'm not a day trader. Not that I'm speaking negatively about that. I'm just saying I consider myself a long-term investor aligned with the principles that you talk about here at Shepherd Wealth Management.
Yeah.
But you really can't predict the future. So you have to understand that while you can do your diligence, there is a chance that you might lose what you invest.
In the short term, for sure, anything can happen. Statistically, I always go back to stats, right? Because that's what this is all about.
Big data energy.
That's exactly right. You're a long-term investor. Time is definitely a huge asset. And time has proven, about 75% of the time over the last 100 years, if you chart the market's up about 75% of the time. We'll be down about 25% of the time. That's something that's pretty reliable. We got a lot of data and sample size that could support that. If you look at all the different asset allocations from, 100% cash to 100% stock and everything else in between there, well, if you hold those asset allocations over long periods of time, meaning that you actually have to do the work to rebalance things, then you can get a pretty reliable outcome, right? It's not a guarantee that you're going to get exactly 8.2% for a 50% stock, 50% bond asset allocation. But if you do rebalance and hold those asset mixes over a long period of time, history would suggest is a pretty reliable performance indicator as to telling you whether or not you're doing about what you should be doing based on what history has to say for that asset allocation. So that's all we're really saying in here is that, you should learn from history. All right. I get that we all have to say, or at least I have to say as a fiduciary that, hey, past performance does not guarantee future results. However, there's enough sample size and history data points here that help us, wrap our arms around the situation. That's why we do this show, is to give people perspective, real quick hitters on what's going on, why it happened, what you can potentially do about it. So I guess with that, we might as well go ahead and start answering some questions for folks here today.
Yeah, we might as well. We actually had somebody just text in, I think, with, we were about to hop into the topical news coverage of the podcast, but s2ep texting out of Shepherdsville, for those of you that don't know, it's a suburb of Louisville, Kentucky.
Glad we got that out of the way.
Distant suburb. Yeah. Actually had something that relates to the news going on. I think a lot of folks, see these articles but don't maybe really understand. But they have this question about the whole Elon Musk and Twitter situation. So it says, please explain the Elon versus Twitter situation. Why doesn't he want to buy? What's up with the bots? And was Twitter overvalued to begin with when he proposed the purchase?
Yeah, so the overvalue part, I mean, that's really why he's not moving forward with the deal right now. At least that's the way that I interpret the situation. I'm not Elon Musk's, attorney or financial advisor or anything like that. I'm just looking at it the same way that probably everybody else is looking at the news, trying to interpret, what his actual thought process is, which, if you're trying to get in Elon Musk's head, best of luck,
Yeah, right.
So this is all just pure speculation on my part, but I'll give you what I think is going on there. So I think he was wanting to purchase Twitter at $54.20 per share, which is roughly $44 billion, give or take.
Yeah, it was $54 and some change. I don't know the exact number. You probably would.
I think it's $54.20. However, the reason why I don't believe that he's moving forward with the actual transaction now, he's using the language bots, meaning that there's a whole bunch of robotic accounts set up at Twitter, and that very well may be the case. I have no idea. I wouldn't even know how to go about finding that information, and I think Elon's trying to get Twitter to open up their data set to show him exactly what's going on there. But I think that he wants to buy Twitter. I think that he got a little extended and excited with the opportunity to purchase Twitter. I just think that he finally realized, probably because a whole lot of other really smart people surrounding him said, hey, you're paying too much for this specific social media platform. You probably could get it to be valued at this point if you did step in as the CEO and owner of Twitter. But you'd have to come in at a much lower price point, right? You're seeing the shares hanging out around $33 or something like that and change.
Well, I mean, since his involvement with the company, it's dropped $20 a share, which is a significant blow to the shareholders.
Well, the reality is it probably, I mean, we don't know for sure, but it probably, the last earnings announcement that Twitter had probably would have taken a significant hit to the stock price anyway. Because if you remember, that's right around the same time Musk said, hey, I want to buy Twitter at $54.20 a share. Well, their earnings weren't all that great when that happened. So the share price probably would have been somewhere down where it is right now. I see that on CNBC as we're talking here, Twitter's down 21% year to date. So yeah, it probably got to the price point to where it should have been post earnings as we're talking right now, or at least something close to it. The idea of Elon purchasing Twitter when they announced their earnings is what kept the stock price kind of elevated anyway. But I think he's just recognizing that this is just a price that he really shouldn't be paying for the social media platform as it stands today. I think that in his mind, he thinks he probably could get it to be worth a heck of a lot more than $54.20 a share. But that's going to take some time, and I don't think that he wants to leverage all of his Tesla stock, all of his company that he's also CEO of.
SpaceX.
SpaceX. Thank you. He doesn't want to leverage any more of that. So I think that's the reason why he's backing out of the deal. And if it costs him $1 billion in breakup fees, first of all, it's going to take years for Twitter to see that money because they're probably going to drag it out in court a little bit. But $1 billion to him is not all that significant.
Yeah, and let's be honest, nothing's coming out of his pocketbook. It's going to be restructured through his company.
Right, and it may actually save him some money on some taxes with $1 billion breakup fee. So,
or I guess the other extreme of it is he could be held in contempt of court, which would be lovely coffee drama for another low Monday.
Yeah, if we got a low Monday, I mean, at least Elon's keeping us busy here at the desk. But yeah, I mean, that's my interpretation of it.
Yeah,
I could be wrong about that, but that's the way I see it. And we'll actually find out how it all ends up here over the coming months, maybe years. And I think that there's an outside chance that he still ends up purchasing the company just at a significantly lower price than $54.20 a share.
Yeah, I mean, this is totally my conjecture about it all. Like Joshua said, no one knows what's going on in Elon's head. I just refuse to believe, Musk will shoot from the hip and be flippant when he's tweeting about stuff, and that's never a good idea for anyone. But at the same time, I don't really think that he would make such a brazen financial move to purchase Twitter without knowing exactly what he was walking into. So I wouldn't be surprised if this was some kind of machination he had planned from the beginning, where he recognized that Twitter was overvalued. He wanted to purchase it, but he stepped in to kind of squeeze it a little bit to get it to be something that he can handle.
Yeah, I mean, we're going to find out
how even someone as driven and obsessed as Elon Musk is can be an effective CEO of SpaceX, Twitter, and Tesla at the same time. And I know that was Twitter's fear, was that if he took over and became CEO, how effective would he really be able to navigate that company into the black like we think he would be able to if he gave it undivided attention.
Yeah.
But one of the things with the bots, and I know this is not a tech show, sorry, it's a finance show, so I don't want to go too into it, but just for our viewers and for everyone else, he's not wrong about the bots.
Probably not.
Bots are programmed. They call them bots. They're not technically robots because it's not hardware. It's all software, right? But it's programmed algorithms that just like infiltrate social media, and on predictable terms, they write their own copy and they just flood with whatever information they're directed to flood. And, you know, that's how you see so many celebrities with elevated, they have 1 million followers, they get likes all the time. Right. Those aren't actually people doing that for the most part. It's programmed robots that are just driving up traffic. And Twitter is filled with them. Facebook is littered with them.
Yeah.
Every social media. So he's not wrong about that. But what you may see happen here is a ripple effect, is if this does go to court and Elon has to prove his research, and, you know, it is revealed that a substantial portion of Twitter traffic isn't actual human beings doing anything. It's just completely made up sphere of, you know, algorithmic likes and, you know, trends in media, then that might infiltrate and be revealed in all other social medias. We could see a devaluing of the metaverse, and this is all hugely in the future and completely speculative, but it's not a small thing that he's bringing this to the attention of shareholders. And
no. And I think that, you know, maybe you're right. Maybe he kind of foresaw a lot of this coming out and playing out the way that it's actually playing out. Maybe he actually has a game plan for it. I still think that there's an outside shot that he actually ends up with Twitter, you know, actually owning it, but sometime out into the future. So, and you know, I do think there is a realistic chance for him to take over, even as he's already CEO of a couple other large organizations, to significantly accelerate the growth for a social media platform like Twitter. I think it could be a lot easier to use, and I think he could probably make a lot of really cool improvements for it, but we'll see what happens. So
yeah, I love it for news. I still have no clue what Twitter's for.
I think a lot of people just use Twitter as an easy way to get some news highlights.
Yeah,
you know,
and a good bulletin board for what you're doing. You know, if you need to make announcements. Like
Which, you know, that platform's probably was certainly not worth $54.20 a share if that's how people are using it right now. But I think that there's an opportunity to do some cool stuff with Twitter. Whether Elon takes over or not is, you know, to be determined. But I think that platform could be a lot better than what it actually is, and probably does need a board or CEO type of shakeup to it. Yeah. But we'll see what happens. You know, who knows? I'm not hating on Twitter.
No,
just reporting the news as I see it.
Yeah, I mean, that's how we got s2ep's question.
Yeah.
Tweet in here to the Shepherd Wealth Management page. So
it's an easy kickoff. I'm sure I think we got at least a couple more here, though, Ez. I don't know if we want to take them now or if we want to take them later.
We can. I mean, they're still coming in as well, so we can take some now and see what shows up, or, you know, you got anything else you want to hit on? I mean, for those of you watching, it was certainly internationally a crazy news week. We had the horrible results of the economic collapse in Sri Lanka, and unfortunately civil unrest and violence. China was fining the major companies there, Alibaba and Tencent, for violating monopoly policies. So
those stocks are taking a hit. Plus, they're, you know, having another wave of COVID over there, and they have a zero, you know, stance policy on COVID. So they're going back into lockdown. So certainly hurting their stocks over there as well. Yeah, I did have a couple of things to get to here as it relates to data this week, but since it's kind of a null week, give me another question here, S.
All right. Well, D'Angelo from Louisville, so kind of close to where s2ep is, says, excuse me. With no change in any of the external circumstances, why have energy stocks begun to draw down?
That's a really good question. That's actually where I've been spending a lot of my time doing research for myself and for my clients over the last couple of weeks, because energy specifically is the only sector of the S&P 500 that's been positive thus far in 2022. But over the last month, it's been the hardest hit sector. Over the last month, down almost 17%. Year to date, still up over 25%. So, and over the last 12 months, up almost 33% in the energy space. So yes, it's been the only bright spot in the S&P 500 sector-wise so far this year, and it has been hit hard here recently. So, how are we handling that here at Shepherd Wealth Management? What I'm doing for clients as we go through these quarterly reviews that we're going through right now, so we sit down every single quarter and kind of talk through, performance, why it happened, what macro economic events kind of affected performance, what should we maybe expect over the next 3 to 6 months, and still keeping, again, the bigger picture in mind here as to why we're investing, why we're taking the risk that we're taking here. So from an energy standpoint, we're going to rebalance sometime between now and the next quarterly review that I do with clients in October. And a lot of the growth has come from the energy space. So we're going to have to take some of those profits and reallocate that to other parts of portfolios that have underperformed. And the biggest laggard so far this year has been technology. So think your NASDAQ type of stocks, specifically the very big ones that are profitable, like your Apples and Microsofts and so forth. So we'll probably shift a little bit of money out of energy into other sectors, stocks that have underperformed thus far this year. And I think in the long run, we'll be very happy that we did that. And that goes all back to controlling the asset allocation for clients. You got to take some profits off the winners, shift it elsewhere. Otherwise, eventually, energy is not going to be the leading sector of the S&P 500. And if you don't take some of those profits off the table, well, eventually the market's going to rebalance your portfolio for you.
Yeah.
It's just going to do it in an unkind way that you're not going to be too happy about, because you're going to give away a lot of those gains that you otherwise could have, moved to some other part of your portfolio and purchase something at a discount price. So that's what we're doing. Now, we're doing all of that at once. Are we selling all energy at once and investing all of those proceeds into something like tech and industrials and other sectors of the market? The answer is no. We'll probably do a little bit of increment investing into those sectors, into those stocks between now and maybe even the end of the year. We'll see. There's not going to be a specific time frame on that. So I'm not getting out of energy in any way, shape, or form. If you've been underinvested in energy, right? The energy sector is only about 2% or so of the overall S&P 500 index, so it's relatively small space, and it has been a very underinvested sector. But if you're underinvested in energy, it might not be a bad idea to consider allocating a little bit more money, specifically if you're adding money to your account on a regular basis, like I do, like every single Monday. I have X amount of dollars going into my investment account, and I get that money invested almost immediately. Like I did that before we started the show here today. That's just part of my Monday routine. And I would highly encourage all those folks that are out there watching, listening to the program, dollar cost averaging is a huge advantage for those that have the resources to do that. So if you're still working, you got a little ways to go until retirement. Highly recommend automating some deposits to your investment accounts, whether it's a retirement account, IRA, 401k, or just a simple brokerage account, individual or joint account. If you have money coming in there on a regular basis right now, you've been able to buy all these dips that we've seen in the market throughout the year. We may have already seen a bottom. I don't know. My intuition and all the data would tell me that it's probably not the bottom just yet.
Yeah.
But I've been making these purchases every single Monday, 6 straight months, buying a little bit lower, buying a little bit lower, buying a little bit lower. And when the market inevitably recovers, I'm still going to keep buying, but my average price is going to be a lot lower than what it would be if I just had, a chunk of money thrown in there on January 1, invested it all, and never added to it for the remainder of the year.
I think the kids are calling that YOLOing.
They probably have been, and probably aren't too happy if they did that earlier in the year. So I guess to fully answer the question, energy has seen a pullback recently because of this fear of recession, which to me, all right, so we have a technical or actually an academic recession. Let's just say that we can show that right now. We don't have all the data points just yet. We might actually be in a recession. We don't know it right now. It's felt like we've been in a recession all year, okay? Yeah. So when CNBC or Fox News or whoever comes out first and says, yeah, we've actually officially textbook-wise hit a recession here in the United States, to me, that should almost be a non-event news-wise because of how bad. I mean, this has been the worst start in the stock market since 1970, right? If you don't feel like we've been in a recession, you've kind of just been, living under a rock in the pineapple in the sea sort of style. Yeah. which you might be happier there than sitting here looking at your brokerage account, 6 months into 2022 and everything's down double digits. But the word recession really shouldn't be anything that freaks anybody out, especially how bad this year is. And by the way, it's an inevitable part of a healthy market cycle and an economy. It's inevitable as a long-term investor. So
it's not fun, but it's coming.
But the market's interpretation of recession as it relates to energy is people are going to travel less. Like I'm not going to go drive my car as much or take that flight to Florida that I was planning on taking earlier in the year or whatever the case may be. That's what the market's anticipating, which is why you've seen a big pullback in energy. But again, I've seen people be locked down for 2 years, right? you can't get a flight right now if you wanted to.
No, and they're way expensive.
Gas prices have come down a little bit based on the 90-day suspension of a gas tax and some other small nuances like that. But it's still, I think I saw $4.60 a gallon when I was driving in today as opposed to $5 a gallon. Like,
yeah, on my commute on Interstate 65, there's a spot, an exit where I know it's going to be the lowest in between the two metropolitan areas. And a few weeks ago, I was seeing it almost at $5, and this morning it was $4.28, which is a significant deduction.
These energy companies can be highly profitable. They're profitable at like $45 a barrel, right? It's not going to come anywhere close to that. And even when we do, because we will inevitably see energy prices roll over, I think we'll get back to quote unquote normal gas prices here. Maybe not this year, maybe sometime in 2023. I'm not sure, but I don't want to hang out. Right now I'm overweight energy, more so than I ever have been. Most of that has to do with growth, and the other part of that has to do with just rebalancing into some energy earlier in the year. But that's not going to last forever for clients here at Shepherd Wealth. Like we talked about, we're going to do some rebalancing this quarter. It might not be done until the end of the year, beginning part of next year, but that's certainly a space I still want some exposure to. Eventually that'll come back down to either a market weight sector for the portfolio, or maybe we'll underweight it at some point. But for now, we're anticipating that we may already be in a recession. We might actually hit a recession sometime later this year. I think it would be difficult to see that happen given how tight the labor market is. There's never been a point in time in history where we've had a recession where the unemployment rate's below 4%. But we'll see. We might actually be in one. To me, it's a non-issue. Markets already have done a lot of the work from a pullback and repricing standpoint. So we got to look to the future here at this point, saying, okay, Fed's going to increase rates here in July. We'll see what the data looks like. Maybe they won't have to raise rates as aggressively in September and the rest of the year. And therefore, we can start to see a potential rally for stocks. So that's the way that we're looking at it here at Shepherd Wealth. But a really good question is something I've spent a lot of my time over the last 3 weeks really trying to get my arms around. Why is energy fluctuating as much as it has been? And if nothing else, it might be a decent entry point if you've been underweight energy for the first half of 2022.
Right on. Well, let's keep rolling with we got another question just came in from Chris N. right here in Cincinnati.
Bring it on.
With the market somewhat stagnant, sorry. We got to get a cough button in here.
Yeah.
Excuse me. All right, here we go. Chris N. With the market somewhat stagnant in bear territory, I'm thinking more and more about a Roth conversion. Your thoughts?
Yeah, it's definitely some talking points I've had with some clients this year. So Roth conversion, for those of you that aren't familiar with it, let's say you have money in a Roth IRA account. I'm just going to pick some numbers here. Let's say it's $100,000 that you had in a Roth IRA account on January 1, 2022. Well, you've probably put a lot of money, like your own contributions, into that Roth IRA account, let's say over the last 5 years or so, and you just invested it, and you've had some growth, and now it's $100,000 on January 1, 2022. Mm-hmm. Well, Roth IRAs are filled with contributions of after-tax dollars, meaning that money probably came from your bank account and went to your Roth IRA account at Charles Schwab or Fidelity or wherever you've had the Roth IRA. And that money in your bank account's already been taxed, right? So money goes from your bank account to your Roth IRA. You invested in some stocks, let's say, or some ETFs, and it grows. Well, the benefit of a Roth IRA account is when you retire and you go to take money out of that Roth IRA account, you don't pay taxes. You don't pay taxes on your contributions, of course, and you don't pay any taxes on the growth of the shares. So if you go from $100,000 to $10 million by the time you retire in 35 years,
planning on it,
congratulations, you get $10 million worth of capital that you'll never have to pay taxes on. This, based on today's IRS's tax code, which could change at any point in time. So that's the benefit of a Roth. So what is a Roth conversion? Usually, it's somebody that has a traditional IRA or a rollover IRA. So let's use the exact same example. $100,000 in a traditional IRA on January 1, 2022, and the market's sold off, as we know. The S&P's down around 21%, NASDAQ's down more than 30%, et cetera, et cetera. So now you're halfway through 2022, and let's say 30% of your money's gone. to the market, right? Still invested in those same securities you had on January 1, they're just worth less.
Right.
All right. So now you got, let's call it 70 grand in your traditional IRA account on July the 11th, 2022 today. So what's a Roth conversion? Well, if you anticipate that the market's going to recover over the long run, like I do, you could convert that $70,000 in a traditional IRA to a Roth, just shifting the shares or cash or whatever's in there from traditional to Roth, all in one shot. Now, when you do that, you do have to pay taxes based on whatever income bracket you happen to fall in. So if you make $100 grand a year and you just move $70,000 from your traditional IRA account to the Roth, it's going to look like in the IRS's eyes that you made $170,000 in 2022. So if you do a Roth conversion, the first point I would point out to you is have cash in some other account other than your retirement account. So ideally, you would have the cash in like a checking account or a savings account at a bank to pay the taxes on that Roth conversion, right? Because you don't want to have to take money out of a retirement account to pay for taxes. Then you end up with a cycle of, I got to take money out of my retirement account every year to pay this tax, which is not the point of doing the Roth conversion. The point of doing the Roth conversion is now you took that 70 grand from traditional to a Roth, right? You paid your taxes, let's say from your checking account at the bank. And when you expect that recovery to happen, well, all that money's in a Roth now. So when that recovery does happen and that 70 grand shoots up to, let's say, 130 grand by the time the recovery is done and over with, well, now you've got all those gains that you'll never have to pay taxes on.
Right.
Right. And you converted the money at $30,000 less than what it was worth at the beginning of the year.
Yeah.
Right. So you're paying taxes on a smaller amount of money. It's still staying in a retirement account. You're paying taxes on the Roth conversion, yes, but the big long-term benefit is now I have all that money in the account I never have to pay taxes on, and when I expect that recovery to happen, I'm going to get all of those gains compounding well into the future, and again, not having to pay taxes on those gains when I do actually go to pull the funds out later on in retirement, assuming that the IRS doesn't change any of the rules related to Roth IRAs.
They never do that. So.
No, but that's an excellent question, and from a financial planning standpoint, years like this where markets are super volatile and we've seen, the types of pullbacks we've seen in stocks across all major indices, it's actually a really excellent opportunity to do something like a Roth conversion. You can almost look at it as like you're not using the gains of the market to pay the tax, but it's almost like the market's paying the tax for you. Yeah. Right. With that inevitable recovery. But again, you want to make sure that you're doing the Roth conversion in a tax efficient way. You don't have to do a Roth conversion all at once. You can do half of it this year, half of it in another tax year, just to kind of spread out the tax liability. Like there's a lot of ways you can go about doing a Roth conversion. But that's generally how most people would do it, all in one shot, and they would want to make sure that they have cash in some other place to pay that tax bill with. And this is an excellent year to consider doing that. Just keep in mind, if you're going to look at doing a Roth conversion, make sure you understand all the rules. Make sure you understand how it's actually going to impact your taxes and all that fun stuff before you actually go pull the trigger. So either go seek out a fiduciary CFP like myself, call me 513-630-2664, or definitely, if you're going to do this on your own, make sure you at least talk to a qualified CPA and accountant. Right. Make sure you understand all the rules, how it affects your specific situation before you pull that trigger. But this is a good year to consider doing that for sure.
Right on. Well, two very good questions. But, my mom's got me on punishment right now, so we're running out of time. I get home.
Well, so we talked about volatility here recently. So I've been doing a lot of research, as usual, here at the Financial Shepherd headquarters. And I am a member of the Sentiment Trader, which is just a platform that gives me a whole bunch of analytics. So I have to pay for this, right? The company here has a whole bunch of analysts, former Wall Street kind of guys, and all they do, guys and gals, all they do is do a whole bunch of research on all sectors of the market, and you can log in here and you can take a look at what that research is showing and how you can potentially use that for clients, right? So one of the things that they did is they wanted to understand the volatility of the S&P 500, and this is going back to 1962. So as of last Tuesday, the S&P 500 suffered a 2% intraday loss. It's the 15th time in the past 50 years that that's happened, going back to 1962. And a cluster of 15 or more days with 2% intraday loss is very rare. It's only happened a dozen times in the past 60 years, right?
Right.
And these little clusters of 2% intraday losses is like a who's who of major geopolitical and financial crisis events. Like, they had the dot-com crash, the Russian default, Black Monday back in the 80s. You got rate hikes and tariffs from the Trump administration. Obviously, the global pandemic that has happened back in March of 2020. And what really all of this is telling us is that over the coming year, because the market has sold off so hard with all this negative sentiment and all the volatility that we're seeing, the next year out plays out to be on an average about a 19 to 20% positive result for the S&P 500. Uh-huh. So yes, volatility is no fun to live through. But as a long-term investor, I mean, it's pretty rare. And when I say pretty rare, I mean like the last 3 years leading up to this year in 2022.
Yeah.
We had a lot of fun. If you were investing in stocks, you're talking double-digit returns for three straight years. But there was still a whole bunch of volatility, right? We still saw a significant pullback in March 2020 when the pandemic happened. Market gave away 4 years worth of gains essentially in a couple of days. Mm-hmm. It only took 41 days to get all that back. Right, I can go back in points in time in history and say, yeah, that felt awful. And some recoveries take a lot longer than other recoveries. But on average, the bear markets tend to last around 280-ish days or so, where the average bull market lasts years on average. So you got to be willing to be a little uncomfortable at times as a long-term investor and either dollar cost average into a down market or pick your spots throughout the quarters of a down year to rebalance things, controlling the asset allocation, just like what we had talked about. And I'm doing that anticipating what this data is telling me. I don't know when exactly we're going to start to see the recovery. I just know that a recovery is inevitable.
Yeah.
Therefore, I want to position myself and my clients in such a way that they can benefit from that recovery.
Right. Right.
That's all we're doing here with asset allocation.
I mean, we can't read.
Yeah, and this is the kind of data that causes me to relax and not feel like I need to be in a big hurry to make a big change. You just can't trade your way out of, 20+% pullback in the major averages. You can't trade your way out of a recession. All you can do is reposition things. And for most people that are trying to do a lot of trading right now, I think the one thing that Buffett said is, hey, if you're in a hole, the best thing you can do sometimes is put down the shovel, right? Yeah. Maybe just reassess the environment that you're in here, and maybe there's a better way to go about getting out of that hole. So those are the types of data points, those are the types of historical events that I am looking for so that I can, one, relax, not be in a big hurry to do a whole lot of anything right now, let the data kind of drive a lot of the decision making. But when I do see data shifting in a positive direction, okay, great. Now we already have this game plan. I've already sat down with all my clients and reminded them, hey, this is what the long-term outlook looks like for you when we run these retirement analysis with something like a Money Guide Pro. Mm-hmm. We can run 1,000 different market simulations, what they call Monte Carlo, with all their different, income sources and expenses and goals and all that sort of stuff throughout retirement, saying, hey, we've actually planned for volatile times like this. Mm-hmm. So we're still good. By the way, we're still planning on, adding to your 401k account every time you get paid. We're still also going to rebalance the asset allocation so that when we do get the recovery, we should still be in a position to capture the gains that come from that without taking on excessive risk based on your specific situation. So that's the kind of insight that I think fiduciaries, certified financial planners like myself should be doing. And if you're not hearing from your advisor during times like this, that's a huge indicator that you're probably not working with somebody that has 100% of your best interest at heart. This is the absolute perfect time for somebody like myself to show what we're worth, right? It's super easy to sit back, especially over the last 3 years leading up to 2022 and say, hey, we're all geniuses. Everything's positive, double digits across the board here. Congratulations. We can all pat ourselves on the back. And yeah, those times come, and I'm not saying that they're not welcome, especially after, times that we're going through right now. But this is really where, financial planners, CFPs, fiduciaries can actually provide a tremendous amount of value for clients. And if you can get folks through difficult times like this, see them through it to the other side, that's a really powerful relationship right there. And that's what we strive for here at Shepherd Wealth Management. And those are all the things that were on my big list here. I think the other thing I wanted to mention as we kind of wrap up today's podcast is, staying invested in turbulent markets. Again, this is an inevitable part of being a long-term investor. So I got some interesting data here. And the S&P 500 has been up 78% in the trailing 5 years. All right, this is data that came out in February of 2022. So the S&P is up over 78% in the trailing 5 years. However, missing 10 of the best days over that 5-year period of time, you're barely beating inflation. Your return's positive 3.75%. And actually, your real return is probably closer to negative due to the high inflation that we've seen over the past 12 months.
Yeah.
So the only reason why I share this information, and this might be information some folks have heard before, some folks haven't, but if you just missed 10 of the best days in the last 5 years, you may or may not even be keeping up with inflation. And by the way, a lot of those best days that came in the last 5 years came clustered around some of the most volatile times that we have seen. So you cannot time the market. You can't get out at the peak. You'll never be able to consistently buy the bottom. And even if you do get it right once, you're not going to be able to repeat that on a consistent basis. So the only thing that you can control, I've said this repeatedly, and I will continue to say this again, well out until the time I die, is that the only thing investors can't control are really two things when you boil it down at the end of the day. You can control your temperament, which is your emotions, which is a huge driver of how a lot of people make decisions, and we tend to let our emotions get the best of us, which is why people go to cash at the worst possible time, or they get too excited about stocks or too overexposed to it at the wrong time. So we can control our temperament, and the other thing that we can control is our asset allocation. So once I get control of my temperament, again, I do that by getting data, doing a lot of research and reading. Now that I have the information I've learned from history, or at least got a good idea of what history might have to say about the subject and how we might benefit from the outcomes that could play out into the future, knowing that with a grain of salt, it's not going to potentially be exactly like it was in the prior time. Now that I got that under control, now I can begin to look at my asset allocation and say, okay, we're going to make some tweaks. And with this kind of data, we know that we're going to need to primarily be invested for the majority of the time.
Right.
I know a lot of clients right now, we're doing some tax loss harvesting. We're simply taking some losses on paper, realizing those losses. And one of the things that we're doing, so we're taking some hits in tech, right? So we sold some tech positions. Well, we got to wait basically 61 days before we can repurchase those shares. Otherwise, the IRS won't allow us to use the loss, right? It's called a wash sale rule. Google it if you want to look it up. I can talk about it in the next podcast. But while we're waiting out that 61 days, we sold some tech shares, right? Well, we don't necessarily want to sit in cash, because if we miss one of these best days, like we've talked about here, we've kind of just shot ourselves in the foot in a big way. Well, we can go ahead and buy an ETF that invests in those same sorts of tech stocks. And because we're buying an ETF, it's a diversified security. Yeah. Right? So we get to actually use the loss. We buy the index, so we're basically still invested the same way. We haven't really changed our risk tolerance. We've actually maybe made it less risky because we now own an index as opposed to just maybe 5 or 6 companies within the index, right? And if we get some gains in the index while we're waiting out that 61 days, great. Now we got a loss to offset the gain with. If we happen to get more volatility over that 61 days and we have another smaller loss to add to the loss that we already had, fine. If we expect these companies to benefit from the inevitable recovery that we're likely going to see, now we can purchase those shares again at a lower price, reset our cost basis, and we have losses to offset the future gains with. So that's the another strategy or approach to managing a portfolio when things are as negative as what they are right now. Again, the only way that you're going to make these decisions of, let's say, buying an ETF after you've taken a loss on those positions that are in that same ETF is you got to know this kind of data.
And where's that coming from again for the viewers at home?
So this is a data report, again, February of 22. And apologize, I'm going to have to put the readers on here, Ez.
Let's do it.
So John Geffert wrote this, and John is Broker Check. So for those of you out there that want to find out some information about your advisor or potential advisor, you can go to this website called brokercheck.com. You can type in that person's full name, or if you happen to have what they call a CRD number, which is an identifier for somebody that has a securities license, you can go to brokercheck.com and find out, what exams did they pass, when they passed them, how long they've been in industry, that sort of thing. So this data came out earlier in the year from BrokerCheck, and we can go back, over any decade in the history of the stock market and find similar data points like this. So I just wanted to share it with everybody today, given that we've had 6 straight months of mostly negative news. We primarily know the reason for that is inflation. The global economy, central bankers around the world are raising rates to combat inflation, and this has happened in the past. Markets have reacted in very similar fashions in the past. And we kind of have a decent idea of what the future looks like, and the future is certainly very bright and positive. So I want to end on a positive note. I think we got all today's viewer questions as well, or do we miss anything else?
We didn't miss it. They're coming in, and we'll get to them at a later episode. Always remember, you can text or tweet your questions in anytime we've got a live episode, and certainly when we do our happy hours on Friday, we got the chat open for anybody who's got a finance question for Joshua.
Yeah, we do the Financial Shepherd happy hour Fridays right around 4:15 after the market closes. We're live on YouTube. It's going to be about 15-minute, maybe 20-minute program. We're just recapping the week, what happened, why did it happen, what we're maybe doing about it here at Shepherd Wealth Management to give you an idea of things you might want to consider as well. But yeah, definitely you can text in the questions, 513-630-2664. It's been a pleasure hosting the Financial Shepherd podcast yet again here today on a Monday. It's going to be exciting earnings season, and I certainly look forward to continuing doing this about every couple weeks. You can also go to shepherdwm.com. That's my website about Shepherd Wealth Management. There's a whole bunch of background information about myself and experience. There's also links to our YouTube channel as well as Spotify. However you like to listen to podcasts, you can either download the Audible on Spotify or watch the actual video on YouTube. So Ez, this has been a lot of fun. We'll do this again in a couple weeks. We'll obviously got the happy hour on Friday. So we'll see you all then. Have a great rest of your day.
Take care, y'all.